Well, joining us now is Dan Niles from Niles Investment Management. And Dan, it's always great to have you on. I want to start with that volatility spike, because usually when you see that, it indicates that there's a flush out happening in the market.
Yeah, I think it's more everybody got lulled into this false sense of complacency. And I know everybody, I'll give you an example of this. Avago, which reported a couple of days ago, they report inline revenues. They guide to inline revenues. Stock goes up 38% over a couple of days. Now, everybody's focused on, well, they did say out several years that this market's going to be a lot bigger. Who knows what's going to happen in a couple of years? And quite honestly, have you ever met a company that a couple of years out doesn't think their business is going to be better? All you know is near term, the numbers don't change and the stock went up 38%. That speaks to complacency. So the fact that the market reacted this way makes next year a lot healthier if people start to focus on the risks as well as the rewards. Micron after the close is another great example of this, where the numbers go down. And they're talking about AI and how they're focused, but revenues go down, EPS goes down, and that makes it a healthier tape for next year if people have to focus on, well, maybe the AI trade is running out of steam, but some of these other sectors that we've given up for dead, like small caps and mid caps, maybe that's a better place to go because they're more U.S. focused. They're not going to deal with the dollar having gone from 103 before the quarter began to 108, and the fact that we're going to have this fall off from election spend, no Olympics, Easter getting pushed out, so Q1 guides could be tough. Donald Trump is more focused on the U.S. economy, and so maybe that benefits the small and mid names, where the multiples are also quite a bit less, and you should see earnings growth, which you haven't seen in the last couple of years.
Okay. And of course, we know pullbacks and even corrections can be healthy for the market, to your point. So if this is setting us up for a healthier landscape for 2025, if you will, then where would you be investing? What looks attractive, especially coming off of a 2024 that was the second year in a row of 20% plus gains for the S&P, led, at least for the first half of the year, largely by the mega cap tech names?
Well, I said this kind of earlier. If you look at the S&P multiple, it's about 26 times. If you look at the mid-cap index, though, that multiple is down at about 18, and the small is right around 22 times. And a lot of these headwinds that we're developing are going to abate for some of them next year, and especially the policies that will happen with this new administration that are more focused on U.S. That should also help those names, because unlike the big S&P 500 names that have a lot of international exposure, where you could have some issues if tariffs are enacted, et cetera, you get into a trade war, they can't sell into those markets. That's not the issue with the small cap or mid cap name. So that's where I'm focused, and I think you're going to see a big catch up next year in that. And if you look at it really as a tail.
So given that, cash is your biggest position after you sold your Mag 7 positions. Why not buy the small and mid caps now with that? Is it because you expect euphoria to continue in the first quarter but then go away, and you expect a better buying point and position?
Well, cash is our biggest position, but small cap value, mid cap value is our second and third largest positions, and we've been adding to that over the last week. So that's exactly what I'm doing, John.